Okay. Hi, everyone. Welcome. We're so glad you're here with us today for part two of our debt webinar series. While we give others a moment to join, feel free to introduce yourself in the chat. Let us know your name, where you're joining from, and the organization you're with. I'll go first with introductions. My name is Jordan Tobias. I'm the manager of grants and programs here at the Foundation for Financial Planning, FFP. And I'm joined by my lovely colleague, Rachel Roth, who's our Senior Director of Grants and Programs. And Rachel will join us towards the end of the webinar for Q&A and to help close us out. But if you joined us for part one, welcome back. And if you're new, we're so glad to have you here with us today. This webinar series was designed to help pro bono volunteers and nonprofits better support their clients dealing with major debt. Before I bring our speakers on, though, I like to take a moment to share more about FFP and our mission to expand access to pro bono financial planning for those who need it most. So at the heart of our work is a simple but powerful question. What happens when people in crisis have access to trusted financial advice? And for 30 years, we've seen the answer. So families overcome financial hardship, regain stability, and start building brighter futures. So at FFP, our goal is to ensure that anyone facing financial challenges can receive high quality financial guidance in order to create a life full of hope and well-being. And we do this in three major ways with your support, of course. First, we develop and support pro bono financial planning programs in partnership with nonprofits across the country. So first, we provide grant funding, technical assistance, and other resources to ensure that these programs are created and that they're sustainable and that they thrive. And then we recruit and train CFP professionals to do pro bono service, and we connect them directly to volunteer opportunities through our platform called probonoplannermatch.org. And then lastly, we lead the movement to foster pro bono service within the profession via original research, industry partnerships, and public awareness activities. So when you get a chance after this webinar, please check out our website and look at some of our original research. But then we also offer a number of resources to support our CFP volunteers. So first, we have our pro bono financial planning volunteer training. It's free, it's CE eligible, it's online, and it helps advisors understand the basics of how to provide pro bono service to underserved members of our community, and it only takes about an hour to complete. Then we offer webinars like this one, worksheets, user-friendly disclosure forms for your pro bono engagements. And again, we have probonoplannermatch.org, which connects the CFPs with volunteer opportunities and nonprofits nationwide. And then lastly, we provide E&O liability insurance to advisors who take our training and then connect with the nonprofit through probonoplannermatch.org. And then moving forward, so before we turn things over to our guests, I want to take a moment to invite every CFP professional here to consider how you could be a part of the pro bono movement. So there's so many ways to get involved, whether that's creating a volunteer profile on probonoplannermatch.org, subscribing to our newsletter to get updates, making a contribution to support the mission. However you choose to show up, know that your time and talent has the power to transform lives. So if you're curious about next steps or want to talk about how to get started, feel free to reach out to me or my colleagues listed here on the screen. And then today we're diving into how to reduce high interest rates with debt management plans. So we're thrilled to be joined again by Joshua Crabb. Josh is the co-founder and CEO of Budge, which is a fintech company providing free personalized debt guidance and access to trusted debt solutions. And then we're joined by Barry Coleman, welcome him in, everyone. He is the Vice President of Program Management and Education at the National Foundation for Credit Counseling. And Barry brings over 2 decades of experience in credit counseling and is a passionate advocate for financial stability in education. So thanks, Josh and Barry, for being here with us today. I'm going to stop sharing my screen. So Josh, you can take over.
Amazing. Thank you so much for having me. I think regardless if you joined the previous webinar or this is the first webinar in the debt series you're attending, this is going to be a really valuable experience because I truly believe that the debt management plan is one of the best debt solutions for people who are burdened by unsecured debt. So I want to give a quick recap around what we talked about during the last webinar, just to give a little bit of context around why we're talking about the debt management plan today. So last time we walked through the fact that we're in a credit card debt crisis with it reaching $1.2 trillion last year, where minimum payments are essentially being optimized to keep people in debt forever. We talked about how planners don't typically work with clients who have debt, but when they do pro bono work, it's actually a top 3 issue. And while there's some amazing debt solutions out there that can help clients, unfortunately, many planners stray away from recommending debt solutions because the space is so predatory. And as a result, they're stuck with strategies like the debt snowball and the debt avalanche. Unfortunately, because cash flow is so tight, many people are unsuccessful with these strategies, or oftentimes it's a false start. So we established that there are good debt solutions out there, but we need to have a framework in order to make that right recommendation. So we need to know what are the right aspects to look at when saying this is the right solution for my client. And then we need to be able to also identify who are the trustworthy partners out there so that we can avoid predatory ones. So today we're going to be leveling up our understanding, specifically by zeroing in on one of the most effective debt solutions out there, the debt management plan. And I'm so stoked that we have Barry Coleman with the NFCC here to walk us through what makes this program so powerful. Um, the NFCC is truly an amazing group, headquartered in Washington, D.C. They oversee a nationwide network of nonprofit member agencies that offer a range of services to help individuals and families manage their finances effectively. Their member agencies, credit counseling agencies, also are the organizations who offer the debt management plans, which again, in my opinion, is one of, if not the best program for people who are burdened with credit card debt. So to kick us off, Barry, can you tell us a little bit more about the NFCC and the populations that you serve?
Absolutely. Thank you, Josh. And it's a pleasure to be with all of you today. So the NFCC services are designed to help really a wide range of individuals who are facing financial challenges or looking to improve their financial well-being. Our services are tailored for individuals with debt. That's those who are overwhelmed by credit card debt, medical bills, or other unsecured debt, or those seeking a debt management plan, DMP, which is a structured plan to repay debts responsibly. We also serve consumers needing budgeting support. And this could be individuals and families who just want to create a household budget to help keep their finances on track. This includes those who are struggling and living paycheck to paycheck, which so many in our nation are today. And those who need recommendations that will help them to stretch their income. Now, additionally, we also help homeowners and renters. And this includes first-time home buyers who are seeking a pre-purchase housing counseling or home buyer education, current homeowners who may be at risk of foreclosure, and even many of our agencies do reverse mortgage counseling for seniors who are considering reverse mortgages. We also help students and graduates. And these are borrowers who are facing student loan repayment challenges and who are seeking guidance on repayment options and federal student loan program eligibility. And there are a lot of changes that are occurring now in that space. So it's helpful to have an advocate on your side. We also help individuals facing bankruptcy. Many of our member agencies are approved by the courts to provide pre-bankruptcy counseling and pre-discharge debtor education, which are requirements in the current federally mandated bankruptcy process. We help military members and veterans, and that includes active duty service members and veterans who are dealing with unique financial challenges such as frequent relocations, deployment-related income changes, or transitioning to civilian life. And then last but not least, those that are financially vulnerable or underserved populations. And this includes low-income families, immigrants, or historically marginalized communities who may lack access to trusted financial and debt advice. So that's a summary of who we help.
Amazing. And so basically what I'm hearing is that if there's someone who is experiencing hardship because of debt, the NFCC most likely has a nonprofit resource that can help. And you mentioned specifically that there's a lot of changes happening in student loans right now, but I think there's also been many changes happening in other parts of the debt ecosystem as well. Can you touch on that?
Sure, be glad to. So over the last 5 years, U.S. consumer debt has grown significantly, reaching over 18 trillion by the end of 2024. And credit card balances are a large part of that. They've hit a record $1.21 trillion with average interest rates around 21.9% and delinquencies on the rise. And this is the highest since 2010. Now, mortgage debt remains the largest category at over $12.6 trillion. Auto loan balances and student loan collections have also increased, unfortunately. And then notably, as we mentioned, student loans, student loan repayments have resumed after a long pause due to pandemic era programs. And this is affecting millions of borrowers, including seniors who still have student debt and are receiving Social Security benefits that could potentially be garnished due to delinquency or default. Now, at the same time, consumer finance landscape has grown increasingly complex with the rapid expansion of buy now, pay later services, app-based lenders, and embedded financial tools. This has all changed how consumers borrow and manage debt. Now, these platforms often operate outside of traditional credit reporting systems, although there is, I believe, some movement in having buy now, pay later plans start reporting to credit bureaus. So that bears some watching. But because most of them operate outside of traditional credit reporting systems, this often leads to fragmented debt and limited visibility into overall household obligations. Now, while fintech innovations have expanded access to credit, they've also introduced new risks, such as higher borrowing without a full understanding of repayment terms or regulatory protections. Now, while demand for credit has declined, especially among small businesses due to high interest rates and economic uncertainty driven by trade policy shifts, cut to regulatory agencies such as the Consumer Financial Protection Bureau, CFPB, have raised concerns about consumer protections, particularly in student loan servicing. Overall, the consumer debt landscape reflects rising financial stress, heavier household burdens, and increasingly diversified and opaque borrowing patterns.
Yeah, so when we look at the ecosystem in debt, there's so much going on. And for people that are in pro bono, and it's like, where do you focus, right? And so at Budge, we actually did a survey of a few thousand consumers last year. And what we found, and this is consumers specifically who are experiencing hardship because of debt, and 80% of them actually said credit card debt was the biggest issue that they were stressed about. And so I think that makes this really relevant, especially for today's webinar, where I know that a lot of you have limited time when it comes to your pro bono clients and how much time and energy you can spend really understanding the debt ecosystem. And that's what makes talking about unsecured debt and the debt management plan so valuable today. So Barry, can you talk a little bit about what exactly is the debt management plan and why advisors should consider it?
Sure. For those who may not completely know, a debt management plan essentially is a structured repayment program which is designed to help consumers who are struggling with unsecured debt, mainly credit card debt that you mentioned. And this helps them to regain stability and better manage those debt payments in the context of their overall financial situation.
Amazing. And can you walk us through just from beginning to end, like what's the process for a DMP?
Sure. So the enrollment process begins with a one-on-one financial counseling and budgeting session with an NFCC certified credit counselor. And this can be conducted either in person, via the phone, or online. Now, the council will review the consumer's entire financial picture, and this includes their income, living expenses, their debts, and their overall financial goals while they came in to see the credit counselor. If the consumer and counselor agree that a debt management plan is appropriate and will help the consumer, then the consumer enrolls by signing a debt management plan agreement which spells out the terms and conditions of the debt management plan. Now, proposals are sent to creditors who are included in the debt management plan. And once the consumer makes their first deposit with the credit counseling agency, those payments are dispersed to each participating creditor monthly until all debts are paid off or the consumer decides to no longer participate in the debt management plan. So it really makes it easier, more convenient for consumers, especially those that have multiple credit cards, because it essentially makes it one single payment, and then the credit counseling agency does the heavy lifting and disperses those payments to the creditors according to the agreed upon terms.
Amazing. And obviously, it's just, you mentioned as long as the client continues to make payments, and that's a critical part of this, is the client needs to be able to continue making the payments. So maybe talk a little bit just about like what makes someone likely to be successful in this program, and like how long does this program last for?
Yeah, so typically a debt management plan runs about 3 to 5 years. Currently, according to our data, the average length of a debt management plan is about 31 months for people that join with an NFCC member agency. Now, this all depends on the amount of debt a consumer has, as well as the mix of payment concessions that the consumer's creditors offer. It's a mixed bag when it comes to creditors as far as the types of concessions that they will offer to consumers. So, a big part of it is, what creditors a consumer might have that they currently owe that are being added to the debt management plan. Now, additionally, and very importantly, consistent monthly on-time payments influence the length of a debt management plan. And other factors such as, sticking to the budget that was created during the counseling session to help keep the consumer on track influences the successful completion of a DMP. And all of these factors influence the length of the consumer's debt management plan ultimately.
And I think when it comes to the length, it's the fact that we're able to make or help a consumer who feels hopeless understand that I'm going to be debt free of my collections, of my personal loans, of my credit cards at this date if I stick to the program. And what we talked about in the last webinar with minimum payments being optimized to just keep people in debt. And if they keep doing minimum payments, they're going to pay credit cards for potentially 100 years. There's a disclosure on the statement. And
Yeah,
when you come into this program, it's I know that I'm going to be over this burden as soon as I complete this program. And
yeah.
that's really something that instills hope and creates a path for someone to push forward. So I think the hope is a big part of it. Having that debt-free date is really valuable. On the other side, there's huge breakdowns around the savings a consumer might see with a program like this. And we actually have a slide Barry's going to walk through. But do you want to talk a little bit just about what the potential savings look like for clients who are in this program?
Sure. So the council will review the terms of the debt management plan, including potential savings from both a monthly perspective as well as potential savings over the life of the program if the consumer were to continue making minimum monthly payments on their own. And there can be a wide disparity. And again, this is all dependent on the amount of debt consumer has, as well as the mix of creditors that they have. But here's an example that was provided by one of our member agencies that basically shows the breakdown here. So let's say you've got a consumer that comes in with a total of $23,460 in unsecured debt. Under the original terms of their debt contract, if they're not in a debt management plan, we found the average interest rate for this particular example was over 28%. And they were paying a total of over $782 a month, just making the minimum payments. And by making the minimum monthly payments, it would take them a whopping 362 months to pay off all of that debt. And that's just astounding when you really think about it. And so the interest rate, the interest that calculates on the debt is over $53,000, pushing the total cost to over $76,000 to pay off the debt. Now, in this example, for those that enter debt management plan, the average interest rate was around a little over 6%. Their monthly payment was cut to about $476, and this includes a monthly maintenance fee that they pay to the credit counseling agency to help to administer the program of $27 on average here. It would cut the payoff time down to 51 months. So we're talking less than 5 years there. The interest that would accrue would be about $3,500, and in the total cost, including the credit counseling fees, would only be $28,405. So as you can see, a significant savings in this example for a borrower entering a debt management plan. Now, I'd like to point out that this example reflects average savings that one of our agencies had for their clients in 2024. Individual results, again, vary by several different factors, and that includes the original amount of the debt, again, the mix of the creditors, as well as the client's state of residence, because that can influence a debt management plan too. Different states have different laws about debt management plans, the fees that can be charged, how the plan is administered, how quickly it has to pay off, that type of thing.
Yeah, and I think there's always the disclaimer around results may vary, but
Sure.
what I can say, and we've been in the offices of some of the agencies, we've listened to phone calls, and what's amazing about referring into credit counseling is these groups really have the heart of the client the same way that you do when you're working with the pro bono client. And
Yeah.
looking at the stats here, you would think these programs would be a lot more widespread, people would know about them, but the reality is because this space is so predatory and it's a multi-billion-dollar industry that profits from
Yeah.
people staying in debt, oftentimes it's hard to know and be able to discern who are the good guys and who are the bad guys. And oftentimes, many financial professionals don't refer to a debt management plan because there's confusion with debt settlement. And while not all debt settlement companies are bad per se, but there is a
Yeah.
lot of predatory practices or bad players that do exist in that industry. And for someone who has who's a CFP, who has a fiduciary responsibility, even the risk of referring into a debt solution that might not have the client's best interest can ultimately make it not worth referring at all. So I think we should clear the air here altogether around just what are some of the main differences between debt management plan and debt settlement, so the people on this webinar have a little bit better understanding between the two.
Sure. I think the key differences between a debt management plan and debt settlement really lies in how the debt is managed, how it affects the consumer's credit, as well as the ethical standards of the providers. So let's take debt management plans. These are offered by nonprofit credit counseling agencies like NFCC members. The goal is to pay off the full amount owed to creditors with reduced interest and fees. Now, as I mentioned, the consumer makes one monthly payment each month to the credit counseling agency, and then the agency in turn disperses those payments to the creditors based on the agreed upon terms in the debt management plan agreement. 100% of the consumer's debt is repaid, again, typically over 3 to 5 years. In debt management plans, credit card accounts are closed. And that's done typically because creditors that are offering concessions don't want the consumer to run into difficulty by adding more debt on top of what they already have, especially if they're offering concessions for hardship reasons. So the accounts are typically closed so that the debt is not growing. Credit scores, when someone's in a debt management plan, generally improve over time. The consumer might see a hit to a credit score when those accounts are closed because, part of the calculation in credit scores is amount owed to available balances. So when the account's closed, that, becomes, an even amount there. But over time, what we see is that as the person is making consistent on-time monthly payments, as the debt is decreasing faster than it would if they were making the minimum payments on their own, that credit score will gradually increase. The NFCC partnered with Ohio State University and released a study back in 2016, which found that, among other things, there was an average of a 50-point increase in credit scores for clients that enrolled in DMPs in the study. And for those of you that may be interested, you can find the full study on the NFCC website. But that's a significant increase in credit scores we found for those that entered debt management plans based on where they started when they entered the program. Now, debt management plans generally provide less damage to a consumer's credit profile, and they help preserve creditor relationships, their relationships with the creditor, because the creditors respect the fact that the consumer wants to pay back this debt, and so they sought help in order to do so. DMPs are ethical, they are regulated by states, and they incorporate financial education into the process, which is a big part of this. NFCC member agencies are 501c3 organizations, and they're classified as educational organizations. So education is a big part of what we do. On the other hand, to compare, debt settlement is typically offered by for-profit companies with the goal to settle the debt for less than what's owed. And the way it typically works is that the consumer stops making payments to their creditors, and instead they make payments to the settlement company. And then after several months of non-payment, the company negotiates lump sum settlements with those creditors. And the debt is settled for less than the full amount owed, but often with higher fees going to the settlement company. As far as the impact to credit, debt settlement can result in severe credit damage for the consumer due to missed payments and collection activity. There's a risk that creditors will sue the consumer before the settlement is reached, and there's also potential tax liability on the amount debt that's forgiven. If the amount of debt that's forgiven is $600 or more, then it's considered taxable income by the IRS. I would also like to mention, though, that the credit counseling industry recognizes that debt settlement may be suitable for consumers in certain situations. Um, and as a result, the industry is working to create programs that are best suited for those consumers who have fallen far behind on their debt payments and can't afford to repay their debts in full. The key is that NFCC nonprofit organizations will never recommend a debt settlement solution unless it's the most suitable option for the consumer. We try to do what's best for the consumer, and so we'll never recommend a settlement solution unless that is the most suitable option for that consumer.
Yeah, I think something that I was thinking about while you were saying that is like the different tiers almost of debt solutions that are out there and based off of the consumer's financial situation. And typically, and I think this is just valuable to understand as you're working with pro bono clients, is when someone starts to experience debt, most likely in order to pay it off faster, they're going to go with a personal loan or a balance transfer card. Ultimately, although there's many articles online that say these products are really good for helping you get out of debt, many times people don't change their behavior and now they end up racking up even more debt on the cards that they paid off with a personal loan or a balance transfer card. From there, they end up doing something like a debt snowball or a debt avalanche. But if they're not successful with that, their situation just keeps getting worse and worse. And eventually, they're not going to be able to qualify for a personal loan or a balance transfer card. And so, as someone's unsecured debt starts to hit a really high level and their credit cards are maxed out, oftentimes that's where a program like a debt management plan can be really effective. And when the debt management plan isn't the right approach, it potentially says, okay, maybe we should start considering a settlement option because the nuclear option that's past that is often bankruptcy. And something that's interesting about debt, the credit score models and FICO specifically, is they actually consider someone that's like 2 or 3 months late on their credit cards. That's actually considered worse than a bankruptcy on a credit file 2 or 3 years ago because it shows that someone is experiencing substantial financial stress, and as a result, they're going to be less likely to uh, be able to be successful with whatever they're applying for. And so debt settlement, actually, you're not paying your lenders for multiple months. You're paying into a escrow account that they're going to use to negotiate. And so the credit effects can be nuclear, but oftentimes are still worth considering when looking at it, debt settlement or bankruptcy, as long as you have the right provider to orchestrate the debt settlement program. And that's where the nonprofit industry is working, starting to develop programs that can actually do this in an ethical manner. Um, and that's where I think like always starting with a debt management plan for a client that's experiencing financial hardship is the right approach. And if a certified nonprofit says, okay, this is not the right program for this client, what else potentially could be available that's ethical and holistic? Um, Now, going back to some questions. So the debt management plan is an amazing program for many people. Like all debt strategies and solutions, though, there isn't really like one silver bullet. What signals or indicators do you look for to determine if the DMP is the right fit for someone?
Sure, that's a great question. So there are several indicators that a DMP might be the most appropriate option for a consumer. And this includes if they have high unsecured debt burden and the debt has become unmanageable by the consumer, perhaps resulting in struggles to make even the minimum monthly payments. Um, while maxed out credit cards may be the most visible indicator, the signs are often less obvious. Other indicators could include recent missed payments resulting in late fees and penalty interest rates above the current average. And it's important to note that the consumer must have consistent income to enroll in a debt management plan. If they're unemployed, then a debt management plan won't work because they don't have the income to make that debt management plan payment. So that's an important factor also, and could be a good indicator as to whether or not a debt management plan is a viable option. Additionally, the consumer must have a willingness to repay the debt in full and must be willing to close credit accounts, which it's hard for many consumers. You know, they've gotten accustomed to having that credit available, and many don't want to give it up. And that's the reason why some choose not to enroll in a debt management plan. They don't want to stop using credit. But that's required by most participating creditors as a condition to enter the program. And the consumer must also be willing to manage their expenses without needing new lines of credit. So they have to stick to the budget that they create in conjunction with their counselor, control the spending and not incur any additional credit.
Yeah, and I think when it comes to closing cards, I was talking to Christopher Viali at Cambridge Credit, and
Yeah.
something that he was talking about was oftentimes you don't need to close all of your credit cards.
Yep.
It's vary from lender to lender. Some lenders say in order to participate with this program, you have to close everything, but it's
Yep.
not always the case. And so, referring a client into credit counseling, they'll be able to determine what's the credit mix. Do they have to close all their cards? Like that, that is something that is considered on a per lender basis.
Sure.
The other thing here, I think it's equally important to understand when a debt management plan is not the right fit. And you touched on a few of them already. At Budge, one of the key indicators that we use to see if someone's the right fit for a debt management plan is, do they have extra cash flow? Their cash flow
Hmm.
situation is such an important indicator, because if someone has, depending on how much extra money they have per month, that could create a really good outcome with the debt snowball or an avalanche where they don't need to enroll into a formal program. So
Yeah.
validating the cash flow situation is a really good way to see, is the DMP potentially not the right fit for this client? And many of the lenders, when they're giving the concessions, for example, if they see that this client has a lot of extra cash flow, then they're not actually going to approve the debt management plan altogether. Can you talk a little bit about, like, what are some other red flags that would suggest a DMP might not be appropriate?
Yeah, and I think you raised some really excellent points there, Josh. We see clients from time to time that are struggling to make their debt payments. And when we sit down with them and look at the income, their living expenses, and their debt, we realize that a bigger problem is their spending. They've got to control, what they're spending in entertainment and, in food. Maybe need to shop around to find a cheaper insurance, but it's more of a spending issue, perhaps, than it is a debt issue. So that's a great point that you raised. But I'd also like to add that a DMP may not be appropriate if a consumer's debt is primarily secured debt, because secured debt is not allowed in a debt management plan. So they can't put a car payment in a debt management plan, that type of thing. Also, if a consumer is looking for debt forgiveness, DMP does not provide this. DMP pays back, the total amount that they owe. If a consumer is seeking to keep, all of their credit accounts open, then a DMP may not be the best option, because there are some creditors that won't allow this. Because some creditors know that, this may not be the best course of action for some consumer, because having those accounts open, they will cause them just to increase the amount of debt that they owe. So, but those are some of the indicators to determine whether or not a DMP is appropriate for a consumer.
Yeah, I mean, something to, as a pro bono advisor, you have such limited time with your client. And as a result, necessarily, like, you're not going to be able to help them maintain their cash flow over time. And closing the accounts does have a good behavioral benefit, that they're not going to
Yeah.
be increasing their debt or their credit cards while they're in the program. And so that's really one of the conversations that you get to have with the client, which is really the importance of this and just how much of a burden debt is in comparison to potentially closing your credit cards for a few years.
Sure.
So talking about maybe when a debt management plan isn't the best fit for a client, and we talked about debt settlement a little bit, but what about other programs like a consolidation loan or bankruptcy? When are those programs better than a DMP? Can you talk a little bit about that?
Sure. So we talked about a DMP being a structured and a reputable way to repay unsecured debt in full with lower interest rates and waived fees, which makes it a strong option for consumers with steady income who want to avoid long-term credit damage. Um, Now, as far as how it compares to other things, let's look at bankruptcy first. So, as you know, bankruptcy provides legal protection and potential debt discharge, but also has severe and lasting impacts on a consumer's credit. It remains on the credit report 10 years past the date of discharge. So it should be considered as a last resort. Bankruptcy filing most often requires hiring an attorney, which results in significant legal fees on top of the debt that they have. Debt consolidation loans, on the other hand, combine debt into a single new loan, ideally at a lower interest rate. However, to benefit from this option, consumers must have good credit. So many times we see consumers that are having debt challenges, their credit has already taken a hit, and so they may not even qualify for a consolidation loans as an option. And consolidation loans can simply lead to adding more debt if the consumer doesn't change their spending habits that may have caused them to get into debt problems to begin with. So, it's essentially trading debt for debt, and that might not be a wise option.
Yeah. Yep. Absolutely. And so we had I mentioned earlier, the few thousand people go through our survey last year, and we actually got the credit score information for a large population that was in debt. And I think it was only 6 or 7% of them could actually qualify for a personal loan for consolidation
Mm.
that actually would benefit them in the sense that they're getting a reduced interest rate. And obviously, they can do an extended term to potentially reduce their cash flow situation or decrease the burden of the monthly payment, but you're just making the situation worse, increasing the total amount of interest paid. And especially in today's interest rate environment, oftentimes this is just not the best solution for a client.
Yeah, and we see many clients that have, tried that route before coming to us. So not only do they have credit card debt, but they have these consolidation loans too. And you can see that, it didn't help them because they didn't really change their behavior there.
Yeah, and actually, I do have some data behind that as well. So we had a few hundred people that responded in a survey that was asked them if they had tried a balance transfer card or a personal loan in the
Hmm.
past. And of the ones that said yes, the few hundred, 70% of them said that they were in the same situation or in a worse off situation uh,
Okay.
when they came into the survey. So it really is like you can go onto a Credit Karma and a NerdWallet, and they're going to recommend balance transfer cards and personal
Hmm.
loans because that's how they make their money. And that's part of the problem with the debt industry if you can't afford a fiduciary to actually give the best recommendation for you. And so that's where we're all in such a unique position where we actually get to give advice to consumers that's the right fit for them by using a framework, by referring into ethical debt solutions and using good tools. So at Budge, we refer into credit counseling agencies, and we oftentimes, um, many of the planners we work with ask, how do you verify the company or the nonprofits that you're working with? And one of the biggest things that we say is that all the nonprofits we're working with are NFCC certified. And obviously that doesn't mean very much unless we're able to actually explain what NFCC certified actually means. And it's actually pretty substantial what these agencies have to go through in order to be certified. So Barry, will you touch a little bit on that?
Sure. So NFCC member agencies are required as a condition of membership to adhere to 18 rigorous quality standards that ensure clients receive ethical, consistent, and professional financial counseling services. All of our member agencies must be nonprofit 501c3 organizations. They have to maintain accreditation through an independent third party, such as the Council on Accreditation, and they must employ certified credit counselors that are trained to deliver unbiased and confidential guidance. Now, these standards require agencies to act in the client's best interest, offering only appropriate services, clearly disclosing fees, and avoiding conflicts of interest. And this commitment to ethical treatment ensures that consumers receive trustworthy support with protections in place to promote fairness, transparency, and accountability in every interaction. And I might also add that additionally, NFCC member agencies are subject to licensing requirements imposed by many of the states where we do business, and they're subject to periodic audits to ensure that they are adhering to those requirements. I once worked at an NFCC member agency, and I headed up compliance, and I had to um, sort of coordinate many of these compliance exams. And I tell you, some of those states come and they're in your office for 2 or 3 weeks at a time, going through everything that you do, even the advice and guidance that you're giving to consumers. So it's very rigorous. On top of this, NFCC member counseling agencies are held to strict ethical and operational standards to maintain their 501c3 nonprofit status. And this is mandated by IRS Section 501Q. So quite a few conditions in order to operate in this business. And again, this is for the benefit of the consumer to ensure that they're receiving professional and ethical treatment.
Yeah, that's truly incredible. And I know a lot of the pro bono advisors on this line, confidentiality, privacy is a huge factor, especially working with some of the populations that some of the nonprofits that work with FFP serve. Can you talk a little bit about the safeguards and assurances that clients have while they work with NFCC member agencies?
Sure, Josh. So clients working with NFCC member agencies really receive several important protections and assurances. And these, again, are all designed to promote ethical, effective, and client-centered financial counseling. This includes counselor certifications. All counselors that counsel clients are professionally trained and certified to provide unbiased confidential guidance, and they have to maintain that certification through continuing education. Our agencies are required to go through accreditation. They have to maintain that accreditation either through the Council on Accreditation that I mentioned, or there's some that are ISO 9001 accredited as well. And this ensures adherence to high standards of service and accountability. They have to go through reaccreditation every so often to make sure that they're maintaining that accreditation. Also, our fees have to be transparent. Clients receive clear upfront disclosure of all fees and services. And we offer those services regardless of ability to pay. We look at every client's situation, and if in order for their plan to work, they're not able to pay a fee, then we're willing to work with them on that. We don't turn anyone down just because they're unable to pay the debt management plan fee. We give client-centered advice, as all of you do as well. Counselors are required to act in the best interest of the client and offer personalized plans rather than just a one-size-fits-all solution, because rarely that one size actually works for every client situation. We maintain confidentiality. Their personal and financial information is kept secure and private. And in the area of regulatory compliance, I touched on this a bit, agencies must comply with IRS Section 501Q, which reinforces protection against conflict of interest, predatory practices, or hidden fees. And all of these safeguards really ensure that clients receive trustworthy, non-judgmental support from agencies that are committed to helping them achieve long-term financial wellness.
Amazing. So many great protections for the clients in the program. So many different things that the agencies have to go through in order to even be a part of the NFCC member agencies. And those are really all the questions that I had. I think before we hop into the Q&A, the last piece that we can walk through are just some of the resources that our organizations make available to you and your clients. So Barry, do you want to start with what's available through the NFCC?
Sure. So the NFCC's website is a great resource, nfcc.org. We on that site include various resources, tools, calculators, recommendations to help the consumer. Also, individually, um, our member agencies maintain, a list of local resources to help consumers also. And this could include things like, food banks, um, information. It could include, social service related information. It could include, employment assistance type resources. And so NFCC members are a great resource when it comes to providing community resources that are tailored specifically to the needs of clients in certain areas of the country.
Amazing. And at Budge, essentially, what we've built is a tool that allows you to assess your client's situation and make the right recommendation based off of how much debt they have, the types of debt, information about their situation from their cash flow to their credit score, and basically outputs a list of different debt strategies with the minimum payment amount, with the total interest paid, and then the debt-free date. And this is a free tool that we're building, or we built specifically for pro bono planners, financial empowerment professionals, and financial coaches. And we have the ability to show, to compare a debt management plan to strategies like the snowball and the avalanche. So you can, as you're in your calls, be able to understand, okay, is this a tool or is this a client that maybe should be referred to a debt management plan? Or is this, should I have them in a debt snowball and I can actually give them access to the snowball plan that I'm creating? And so both of these resources, whether you're referring to the NFCC or using their tools or you're using Budge, all of these are available to you as options so that you know you're not alone as a planner dealing with this wild west of debt, and ultimately you have good solutions for your clients. And so with that, I'll hand it back to Jordan and Rachel with any questions that we've received in the chat.
Thank you so much. This is a really great webinar, really relevant topic, so many questions. I'm going to try to get to some of those questions, but before then I want to do some housekeeping. So for the CFP professionals in the audience, FFP will report your CE credit to the CFP board, so you don't have to worry about that. For the AFCs in the audience, the code is FFP 19. And Jordan just put that in the chat. And that's the code that you need to report your continuing education credit to AFCPE. Just for AFCs, we'll report the CE credit for CFPs to the CFP board. So with that, I'm going to try to get to some of these questions. Unfortunately, I think the NFCC website might be down at the moment. We've had some questions about that. But just because people might be trying to search it, can you just recap how you find NFCC agencies in your geographic area, or how does a client pick from the NFCC partner agencies?
Yeah, absolutely. So the best way is to go to nfcc.org. On that home page, there's a red button that says Get Help With, and then the consumer can select the type of help they're looking for, either credit card help, budgeting help, home owner guidance, that type of thing. And then when they click on that, it just asks for certain basic information. Zip code is important because it helps to connect them with agencies that are licensed to do business in their geographic area. And then the consumer can get connected with a counselor. And there is an option too for those that are looking for counseling in Spanish to choose Spanish as opposed to English. But that's the best way for consumers to get connected. And I'm looking at the NFCC site now. At least it
Yeah,
appears. Yeah.
it seems like it's working again now. So
Okay. All
great.
right. Great. Great.
Thank you.
Mm-hmm.
What happens when a client decides in the middle of a plan that they no longer want to participate? What
Yeah.
happens to the DMP and what happens with creditors?
Sure. So DMPs are completely voluntary, both on the side of the creditor and the side of the consumer. So once someone enrolls, they're not obligated to stay in the plan. They can leave it at any time. And really, oftentimes we see people, they enroll in the plan, they get those concessions, they pay off some of the debt, and then they get to a point where they say, well, I can handle this on my own. And oftentimes what you see is that the creditors will continue to honor those concessions that the consumer was granted by being in the program. Although there's some creditors that may put those payments and terms back to the way they were before the consumer entered the plan. But consumer can leave whenever they want.
Thank you. And is it possible to enter into a DMP when the debt is already in collection?
Yes, we see that quite often. When accounts are in collection, we can enter them into debt management plans. We do work with many of the collection agencies. Sometimes the terms are a bit different, once they've been past the collection, but most collection accounts are eligible for DMPs as well.
And what transaction cards are available after the credit cards are closed?
I'm not sure I quite understand.
So if like consumers are unable to use their credit cards when they're in a debt management plan, are there other cards that are available that they can use?
Well, yeah, I would say like, Visa, MasterCard debit cards, but of course, they're debit cards and they draw out of bank accounts. And oftentimes that's what consumers will turn to. And of course, they provide the convenience of being able to, use it online or what have you, but you're not spending, you're not incurring debt. So that obviously is an advantage to that.
And so if the client closes their credit cards to participate, and they don't have other sources like a mortgage, how do you coach people to rebuild their credit?
Yeah, I think the important thing is to adhere to the terms in the debt management plan is probably the best advice that I can give, because again, what's happening over time is they're making those minimum monthly on-time payments. Their credit is going to improve over time. So they'll get to a point where, they'll be in pretty good shape and, will be credit worthy or appealing to potential lenders, at some point in the future.
And can you talk about debt management plans and medical debt?
Yeah, and that's a really good question. Many medical providers will accept payments in a debt management plan. Now, some of them may not offer any concessions, and in some cases, there's no interest that's accruing on medical debt, so it's really not necessary. But most medical providers will accept payments through a debt management plan. And I know that our member agencies see quite a bit of that. Anything from, large medical practices to small, mom and pop type medical institutions also. And, we at least try to reach out to all of them to encourage them to accept payments through a debt management plan, because we know that it helps the consumers when they can make just one payment, and then we disperse it to everyone, including those medical providers.
Thank you so much. We've had some questions about like getting CE credit. So if you have a question about CE credit, I'm just going to put my my email address and my colleague Jordan's email address into the chat so you can reach out to us independently. But if you don't have any questions about CE credit, thank you for attending this webinar. We're going to keep it on or Jordan, can you just type it in while I'm speaking? Thank you again. Thank you all for attending. I'm sorry I couldn't get to all the questions, but just be in touch, and we look forward to having you at future webinars.
You all.